G'day there, Ray Corcoran here. In this week's video, I'm going to be going over 3 different ways that you can buy a property in Australia with less than a 20% deposit. So the property market has been on a bit of a tear recently, pretty much Australia-wide, with property prices rising as much as 20 or even 30% in some areas. Now, for a lot of people that are first home buyers, they're trying to get into the market. Typically, most people do a 20% deposit very commonly. 20% is becoming an ever-increasing number for people. So it's kind of feeling like, their earnings aren't catching up to how much property prices are growing. So a lot of people are asking, well, do I even need a 20% deposit? And the good news is that you don't. And today I'm going to go through a few different options that you do have so that you could buy a property with a 5 or a 10% deposit and stuff like that. Many of the major banks won't actually lend people more than 80% of the property value. They have something called, you may have heard, LVR, or loan to value ratio. So if you're trying to borrow 80% of a property value, then your loan to value will be 80% of that property value. So there are some lenders that do allow you to borrow a higher percentage, but sometimes that can come with different conditions or extra conditions and sometimes worse interest rates. But we'll go into that in a second. And if you find the video useful, please give it a like. It does help the video get more exposure, and I'd really appreciate it. So the first most common option is, usually doing a deposit around 10% and paying the fee, which is known as lender's mortgage insurance. And in America, it's called PMI, private mortgage insurance, but they're the same thing. And basically that means that you're going to the bank and saying, hey, I want a loan for this property and I've only got a 10% deposit. And they'll say, okay, we'll let you get the loan, assuming that you meet all the other criteria, but you do have to pay an extra fee because this is a little bit more risky for us. And on a $500,000 property in Australia, say you had a 10% deposit of $50,000, lender's mortgage insurance for that will be around $10,000 in New South Wales. And it does vary depending on the size of the loan and the value of the property and also what state you're in. So it can vary a little bit state to state. The downside to this is that you do have less equity in the property. And for me, I guess on paper, sometimes it can be more beneficial to put down a smaller deposit and have less money in the deal, so you can go and buy multiple properties. But for me, I don't know, I've always not liked the idea of putting down a tiny deposit. I've always put down, for all my investment properties, I've always put down 20%. And that probably has meant that I've grown my portfolio slower than other people. But I like optimizing for the sleep at night factor as well. I don't like just putting down tiny deposits and, I don't like too much risk, even though there are other people that have grown their portfolios faster and made probably more money by putting down a tiny deposit and then just, doing one property after the other. But one of the upsides of paying that fee is that, if you're in a growing market where the property prices are rising rapidly, it can be actually more financially beneficial for you to just put a small deposit down and pay LMI or PMI. So say, for example, if you have looked at a property that's 500,000, you have 10% deposit, 50K, and you decide, you know what, I'd rather get in the market now rather than wait maybe say 12 months to save up the other 10%, so you have 20% and you don't pay LMI. What will happen is you'll have 50K, you'll have to pay a 10K fee for LMI and a few other little fees. And what that will mean is you can get into that property for around 60K plus some other fees, as opposed to you having to save up 100K plus those same fees. That's something to keep in mind. If you think the property is going to go up by 10% in a year, that property is going to be worth 50K more in 12 months. So if you to pay a 10K fee to get a property that is going to be worth, or you expect it to be worth 50K more 12 months from now, then you may save money that way. So you're always going to do some calculations and make some guesstimates in terms of where you think the property is going to go. But paying LMI can be a great thing. And I know many people that are totally happy to pay that fee because they know that they can get into a property much sooner and also have less money in the deal. The second option that you have is having someone go guarantor on your loan. So a guarantor loan can be when you have typically a family member, usually a close family member. So it could be mum, dad, brother, sister, grandparent, child in some instances. There are some banks that will consider extended relatives and also things like ex-spouses, but depends on which bank that you go with. But basically what happens is you're having someone else sort of take on the risk on your behalf. So if the bank goes, all right, you've only got 10%, we're going to guarantee the other 10% that you're missing with this other person. And basically what happens is if you can't pay your repayments, they will be the ones that have to make those repayments. And this has to be a property that you live in. It can't be an investment property. And you also can't own any other property. So if you've got 10 houses, you can't go guarantor, or not to my knowledge. Another thing is if the person going guarantor, say it was your parents and they've got their loan with one bank and you're applying for a loan through another bank, typically they will need to refinance to go across to the same bank so that they can do the transaction. And say on a 500K property where you get 50K saved up as your own deposit, then the guarantor will basically offer up $50,000 of equity in their own property as security. But the benefit is that you don't have to pay LMI, so you can save the money, they just have to vouch for you basically, and you get into that property without having the 20% deposit or paying LMI. And the amount that is required to be guaranteed by the bank can vary from bank to bank. So obviously it's a very, very case-by-case basis depending on which bank you go with, what your situation is, how much you want to borrow, and all that sort of stuff. And number 3 is the first home loan deposit scheme. So this is relatively new and has got a few different conditions to it, but this is also an option that the government has introduced, partially due to housing affordability being non-existent in Australia, especially Sydney and Melbourne. What this will allow you to do is to get into a property, and it's almost like the government is going guarantor for you. And it's designed for first home buyers and helping them get into the market sooner. It originally started with 10,000 spots available that the government had offered, and that was from 1st of July 2021 all the way to 30th of June 2022. And kind of due to all the stuff that's happened in the last 2 years and people haven't really had a chance to potentially buy properties, the government's actually added an additional 4,651 new spots available. And those particular spots are available from Monday the 31st of January 2022. So that's only a few days ago that those new spots have been opened up. So if you are keen, you should definitely check it out. And basically the way it works is that you would get a loan from one of the approved participating lenders, and the government would guarantee a portion of your loan. And it can mean that you have a deposit of as little as 5%, which is crazy. And it's great if you're someone that's looking to get into the market. One caveat, hopefully, if you do put down a small deposit, hopefully you actually can service the loan. So if you can only raise 5% of the property value, personally, just from a common sense point of view, make sure that you can actually service that loan. And obviously the banks will check that you can service a loan. If you're just scraping in and the repayments are really, really going to stretch you, that's something you really need to think about. And any guarantee of the loan is going to be up to 50% depending on how you're assessed by the lender. And if your home loan is covered by the scheme, you also get access to some of the other government schemes around first home owners. So it could be stuff like first home super saver. There's other stuff like home builder grants, first homeowner grants. So there's a few other things that you will also get, or can also get access to, if you do get your loan approved by this scheme. And you do need to look into all the different criteria. There's a lot of detail around each of these different schemes and what you're allowed to do. There's going to be things as well like price caps. So if you are in, say, Sydney, there's only so much. You can't just go buy like a $4 million first home. Using this particular scheme, there's limits of, it could be 300,000, 500,000, 700,000, that sort of stuff. Typically in New South Wales, the price caps are higher, and elsewhere in the country where houses are a little bit, cheaper, the price caps are lower. And on their website, the government website, I'll give you a link as well to the postcode checker. So basically what you'll be able to do is check, the areas that you're looking in, and then they'll tell you what the price caps are for that particular area. And for the property to be eligible under the scheme, it has to be a residential property. So an existing house, townhouse, apartment. It could be a house and land package. It could be a off the plan apartment or townhouse, which are probably terrible investments, but that's none of my business. Or it could be land and a separate contract to build the home. And they all have their own little requirements and criteria. So make sure that you check depending on what specific property that you actually are looking at. So there you go. There are 3 options that you have if you're struggling to maybe save up that 20% deposit for your first home. Have a look into these. Speak with your broker as well. They're often a great resource for you in terms of what you have available to you. The first property is the hardest. Like I found that I was no different to anybody else. Second one gets a bit easier, and so on. After that, it does get easier and easier, but just getting into the market, it is pretty wild at the moment. So getting into the market can be made easier with some of these strategies. So I hope you found that useful, and I'll see you on the next video.